Part 4, it is not, I promise you, going to be as long as the other parts. And in fact, there's no handout that accompanies this. So we've got a couple of ratios, metrics. Free cash flow. Free cash flow shows up in a lot of the websites for the financial reporting, Yahoo Finance, Hoover's, anywhere where you see key performance indicators. So free cash flow is a calculation. You use the cash flow report to get these three pieces of information: cash from operations, and we saw that with Computer Services Company, and that was cash from operations $172,000 minus capital expenditures, and we usually do net of sales. I noticed that in this textbook they don't always include that, but if we were to do that, we would say minus $141,000 and minus dividends, and in this case dividends are $29,000. So if we were to calculate free cash flow for Computer Services Company, we would take 172 minus 141 minus 29, and you would have free cash flow of $2,000. And this means what cash is left over after we adjust for capital expenditures and dividends. And in Computer Services Company's case, not a lot. And there it is. All right, supplementary material. I am going to present to you information that is not in your textbook, and it is cash flow and the product life cycle. The product life cycle, you may have studied the human life cycle or the life cycle in biology. And the life cycle, in very simple terms, is introduction or conception. The next phase would be growth. The next phase would be maturity. And the last phase would be decline and ultimately death. So products have those same life cycles. They are introduced into the marketplace. Sales are pretty low. Growth phase means that the product becomes more popular. Maturity means the product popularity has leveled off. Everybody has one. You don't necessarily need a second one. You may replace the one you have if it breaks, but essentially you're not in the market to buy more. And then decline when the product is no longer used. For example, cassette players is in decline. They still sell them, but it's harder and harder to get them. So we're going to relate the product life cycle and the phase that the product is in with its cash flows. So let's talk about introductory phase. So let's assume, just to make this very simple, to get the concepts, let's assume this is a one product company. So you would have a cash flow report for this company, and you would probably see this pattern. Cash from operations would be negative, cash from investing would also be negative, and cash from financing would be positive. Now, why is that? Let's think about it. Why would cash from operations be negative? Cash from operations is positive when net income is positive. For an introductory phase or a startup company, often they don't have positive net income. They often have losses for the first few years. Cash from investing is negative. Well, what do startup companies do? They invest in assets. So cash from investing would be negative, which means they have a cash outflow position. They're buying stuff. Cash from financing will be positive. Well, they can't pay for those assets through operations. They have to pay for them through financing, through loans or common stock. So if you see an introductory product, what it influences on the cash flow report are these patterns. So what are some products that are fairly new in the market right now? What would you say is a product that's just recently been introduced? Sometimes you have to think about that for a little bit. In our country, it's a lot of this stuff is service products, different features. Maybe on-demand TV is still kind of in its introductory phase. Certain types of cell phones are in their introductory phase. You could argue that the iPad is in its introductory phase. All right, growth phase. Growth phase means sales are going up. When sales go up, when demand goes up, the company has to expand its production capabilities to meet that demand. However, because sales are going up, profit will start to turn positive. So net income will start to be positive. So you may see small amounts of cash to be generated from operations. So when you get down to that line, cash from operations, it's no longer going to be hugely negative as you would see in an introductory phase. You would see it start to be maybe close to zero, but a little bit more than zero. Cash from investing will still be negative. Why? Because the company's trying to meet this demand. So they're building new factories, maybe they're buying new equipment, maybe they're building new stores, all of that. Cash from financing is going to still be positive. Again, if you're in a growth phase, it's highly unlikely that you will be able to finance all the growth from operations. You need a lot of capital quickly. When Starbucks made the goal of opening one store a day, they couldn't finance that through normal operations. They had to go out for additional financing. So who's in a growth phase now? What products are in a growth phase, would you say? And I would argue that the big screen televisions, the digital televisions are still in a growth phase. People are still trying to buy them. If they bought one, they might be buying a second one. Certain cell phones are certainly in a growth phase. All right, maturity. Sales and production level off. And I mentioned in maturity that everybody has one. Nobody's looking to have a second one. Because everybody has one, there's no opportunity to sell to people that don't have one yet. So what happens? Cash from operations is very profitable. Cash from investing will be neutral. You're not building out, you're not opening new stores, you're not building new factories. And cash from financing will be negative. Now, what makes cash from financing negative is the company is paying out dividends. That's a cash outflow. And the company could also be paying back bonds payable, any kind of debt that they have. They have enough money through operations to pay down those debts. So what product would you say is in its maturity phase? Would you say the television set is mature? Or would you say it's in decline? Would you say a normal cell phone is mature, or is it still in growth phase? Decline phase. Sales and production are declining. In other words, when it breaks, you're not replacing it. You're going to be getting a different product altogether. So gradually your market share gets smaller and smaller and smaller. And we see this in technology all the time. We see with tape decks, we see even with CD players, there's alternative media choices. So yes, you might have a CD player, but you may not replace it because you're using an iPod or some sort of MP3 player. So those products are just gradually losing their market share and it's getting smaller. Now that means sales are going down, which means that profit will be going down. So cash from operations will decline compared to previous years. Now, cash from investing might become positive. Now, what causes a cash inflow in investing? And we just saw it with Computer Services Company. If you take a look at that cash flow report, when you invest in assets, that's an outflow. But when you sell off assets, the cash proceeds are positive. So what happens to companies when they don't need as many factories? They sell them off, and that's where you'll see positive cash inflows in the investing area. Cash from financing will continue to be negative as it was in the maturity phase, and you'll see them paying back debt and paying dividends. All right, your assignment is to understand those 4 phases in the cash flow, in the product life cycle. If I give you a cash flow report, I want you to make an assessment. This is an essay question, and it will show up on your next exam. I want you to assess where a company appears to be in the product life cycle based only on the evidence that you see in the cash flow statement. So let's take a mystery company. And I didn't put all the details here. I'm just putting the summary lines. Cash from operations, cash from investing, cash from financing, net change in cash. To the best of your ability, what stage in the product life cycle is this company? Well, we've got 3 years of data, which is nice. So you can see a little trend analysis here. Cash from operations is, $6,796,000. And by the way, these numbers are in thousands, so that's a much bigger number. And we're seeing that it's going from 2009 as compared to 2007, there's a decline. Cash from investing, we spent a lot more in 2007. We're spending less in 2009. And over here in financing, now that's a little different pattern. We have a significant lower amount here. In other words, a cash outflow here, but still an outflow for all these years. So what does that mean? We're paying back debt or we're paying dividends. So possible answers. Cash from operations it is true they are positive. Cash from investing is negative. That's a good sign. It means they're buying. This is strong evidence that the company is growing. It's investing in new stores, manufacturing plants, new equipment, or building. Now, this is a typically ambiguous statement. Cash from financing is negative. You don't have a pattern that quite fits this. So I would say it could mean that it's an established company that is paying back creditors and paying dividends, but it still has enough money through operations to expand. And the good news is it's got a strong cash flow position from operations. So that's a sign of strength, of overall financial strength, and it's also a sign that the company is in a growth mode. So what company do you think this is? And the company is Pepsi. All right, that concludes chapter 13. That's another one of my favorite chapters in the book. I've gone from being very intimidated by the cash flow statement to actually really enjoying the vast amount of information it reveals about the company. And remember, when you are considering working for a company, pull up their cash flow report and look and see how much they're spending on investing. As a future employee to that company, you want to work for companies that spend money on new equipment, new software, new products, because that means it's growing and that means that there's going to be more opportunities for advancement. Goodbye and good luck.